Hello, my name is Jim Leo and I am partner at TvH Group and president of TvH Financial Wealth Management. Many of my clients ask me about life insurance and are always looking for the cheapest option without fully understanding how different insurance contracts work. There is the minimum one can pay for a given amount of insurance coverage for a specific age and the maximum one can pay. So who determines the minimum? Well, the insurance company does. Now at the other end of the spectrum is the maximum one can pay for a given amount of coverage, and who determines that besides you? Well, the government does. The fact that the government limits how much money one can put in a life insurance policy says what about it? It must be good, right? And it must be good in relationship to taxes. So the following video is a 10-minute lesson on life insurance and will help you understand your insurance options and the added benefits certain contracts offer the insured. Please keep in mind the video was produced for American consumers and uses American terminology, but the rules also apply to Canadian contracts. If you would like to find out more, please call to schedule a meeting. Thank you.
There is the minimum one can pay for a given amount of insurance coverage for a specific age and the maximum one can pay. Who determines the minimum? The insurance company. At the other end of the spectrum is the maximum one can pay for a given amount of coverage, and who determines that besides you? The government. The fact that the federal government limits how much money one can put in a life insurance policy says what about it? It must be good. And it must be good in relationship to one subject, taxes. Basically, the government decided the upper limit of tax-advantaged growth they would allow, and the policyholders still have access to the cash value. Policies outside this allowable corridor are determined to be a modified endowment contract, or MEC, which simply means the government will treat the insurance contract like they do qualified plans, with all the rules, regulations, and penalties. After watching this video, you may know more about life insurance than many life insurance agents. At a minimum, you may learn something you've never heard before about life insurance. There's almost an infinite amount of premiums that can be charged between the minimum and the maximum. As mentioned earlier, the insurance companies determine the minimum. They have actuaries that calculate the least amount of premium they can charge and still make a profit. They understand opportunity cost, which means they've factored in the time value of the premium. In the 1980s, the government drew the line that determined the maximum amount of contributions allowable for a given face amount of coverage. They accomplished this with two laws, TAMRA and DEFRA, the Technical and Miscellaneous Revenue Act of 1988 and the Deficit Reduction Act of 1984. Let's assume you could pay $500 for $500,000 of insurance coverage, or you could pay $10,000. Which would you choose? Being bargain shoppers, $500 may sound best. Less is best when it comes to cost, right? Let's say the $500 represents the lowest premium one can pay for $500,000 of coverage at a given age. The lowest premium is known as term insurance. It provides one benefit, death benefit. This type of coverage is called term insurance and offers protection for the least expensive initial cost. The best day financially to own term insurance is which day? If you guessed the day you die, you weren't even close. The best day financially to own a term life insurance policy is the first day. That's right, it's the first day you buy it. Had you purchased the policy today, received company approval, signed the delivery receipt, paid the first premium, and died on the way home from your agent's office, you cannot get better than that. To calculate the rate of return on such an event would be next to impossible. Granted, it would be hard to get people to sign up for this type of financial windfall, but you understand the point. If the best day to own a term policy is the first day, it means that every day you own it, it becomes worth less and less, costing you more and more. When determining the cost of term insurance, one must also factor in the opportunity cost of owning this product. Remember, the cost is not just the amount you paid in premiums, but what those dollars could have earned had you not bought the coverage and taken the risk yourself, which we are not suggesting you do. Penn State University completed a study on term insurance policies where they discovered that more than 90% of all term policies are terminated or converted, 45% within the first year and 72% within the first 3 years. Less than 1 policy in 10 survives the period for which it is written. After 15 to 20 years of exposure, less than 1% of all term policies are still in force, and only 1% of all term insurance resulted in death claims. What does this mean? It means with term insurance, you'll most likely pay more than you receive. For an insurance company to suggest you contribute $10,000 to a policy with an initial value at death that could get you for $500, they'd have to come up with some serious benefits. Agreed? So let's forget about insurance for just a minute and talk about benefits. In any vehicle one would use to accumulate money over time, a major desire would be to maximize benefits, in addition to achieving an acceptable rate of return. If you could wave a magic wand, what benefits would you desire? Would you like the money in the account to grow tax-deferred as opposed to taxable? Would you want tax-free distributions? Would you want a competitive rate of return? Would you like to be able to make large contributions if you had the ability? Would you like additional benefits, self-completion, disability protection, protection from creditors? Would you want it to provide collateral opportunities? Would you want the money to be safe? Would you want no loss provisions, meaning you can't lose it? Would you want guaranteed loan options, so you can't be denied access to your money? How about unstructured loan payments, where you determine the payment schedule? Would you want liquidity, use, and control of your money? Would you like your contributions to be deductible? You would want the maximum amount of benefits possible. There is only one product that currently offers the majority of the benefits on the list, and it's permanent life insurance. However, not just any type of contract will do. Life insurance policies that are minimally funded only provide minimum levels of benefits. Remember, the government drew the line that determined the maximum amount of contributions allowable for a given face amount of coverage. Contributions over this line create a modified endowment contract, or MEC. However, contributions made right up to this line create a different type of MEC that we call the maximum efficient contract. Permanent life insurance contracts offer all the benefits listed earlier, except that the contributions to a life insurance contract outside of a qualified plan are not deductible. You may be surprised to learn that there is little to no difference between deductible and non-deductible contributions. In fact, tax-deductible contributions that grow tax-deferred and come out taxable are exactly the same as after-tax contributions that grow tax-deferred and come out tax-free, assuming the same tax brackets and investment interest rate. What you should understand is that as you move from the highest possible premium to the lowest, the value of the benefits decrease. The higher the premium, the higher the level of each benefit received, until you reach the MEC line. Up to that line, but not over, is the position that provides the greatest amount of benefits a life insurance contract has to offer, while still allowing liquidity, use, and control of your money. There are circumstances where death protection and a low-level premium is desirable. In this situation, or when coverage is needed for a short period of time, term coverage may be the best immediate temporary solution. If, however, you're looking for a place to accumulate money that provides the maximum level of benefits, permanent life insurance can be a solid choice. Currently, we know of no other financial product that offers these same benefits at the same level of contribution. Insurance companies limit the amount of death protection one can purchase, known as the face amount, based on present age, mortality costs, current assets, and income. The government set the MEC guideline to limit the amount of contributions allowable in the form of premium payments that still give the policyholder access to the cash value on a tax-favored basis. How much insurance should you have? Most of us assume this is a needs discussion. The discussion is really about wants, not needs. There's no one wise enough to determine what one needs, since the very thought of need represents the least amount. A least analysis approach would be to assume that if one purchased the least amount of coverage and died, the amount received would be adequate. It would be hard to find anyone who has been successful at anything who began by calculating the least they had to do to make it. Life insurance should be considered a want product. You decide what you want to happen. Then it can be determined how much coverage it will take to provide the protection you want. Life insurance can provide the immediate funds to provide the money to make sure that what you want to happen will happen in the event of your death, and additional benefits as well as access to your money while you're living. Make sure your policy will ensure that what you want to happen will happen.